The patient is on the table. The lights are aggressively bright. The monitors are just screaming with activity. And if you just glance at the vital signs, the stock market tickers flashing that relentless green, the record highs, the sheer unadulterated euphoria.
The AI narrative.
The AI narrative, exactly. You would say this patient isn't just healthy. You'd say they're an Olympian. They have flushed cheeks, high energy, they're sprinting a marathon.
But you know as well as I do that flushed cheeks aren't always a sign of vitality. In a medical context, and well, certainly in a financial one, they are often the first sign of a fever.
A really high fever.
A fever that is burning, dangerously, perhaps lethally hot.
And that contrast is exactly where we start today. It's the setup for a bit of a horror story, really.
Mm.
Imagine you were in the operating room. The patient, the U.S. economy, the stock market, seems fine on the surface, but then the chief surgeon, he just stops.
And this isn't just any surgeon.
No. This is the man who has successfully operated on this patient for 60, maybe 70 years. He has seen the dot-com cancer, the 2008 cardiac arrest, the inflationary flu. He stops, he takes off his gloves, he washes his hands, and he walks out of the room.
And he doesn't just walk out. He liquidates his instruments on the way to the exit. He sells the scalpels, the clamps, everything.
That chief surgeon is, of course, Warren Buffett. And the mystery we are trying to solve today is why the most famous optimist in history, the man who told us all to buy the dip and bet on America, is suddenly, and very publicly, refusing to play the game.
It's more than refusing to play. He's actively taking his chips off the table.
Welcome to the deep dive. Today, we are performing a forensic autopsy on the Berkshire Hathaway portfolio. We aren't just looking at what he bought or sold. We are looking at the corpse of his strategy to understand why he killed it.
And it is a pretty disturbing picture when you really dig into the 13F filings. We have a mountain of evidence here. Financial reports from the big transition to Greg Abel, tax implications, and a whole host of macro indicators that suggest this isn't just a simple portfolio rebalancing. This is a full-scale retreat.
A retreat? Or is it a fortification? Because that's the central question here, isn't it?
Yeah.
Is this just an old man getting conservative because he's stepping down? Or does he see a fatal blood clot in the market that the rest of us are too busy chasing the latest AI stock to notice?
To answer that, I think we have to look at three distinct areas of this autopsy. First, the body count. The sheer, almost unbelievable amount of cash he has hoarded.
The war chest.
The war chest. Second, the dissection, the specific crown jewel stocks he cut out of the portfolio. And third, and this is maybe the most important part, the diagnosis, the macro indicators that I believe terrified him into action.
Okay, let's start with that forensic evidence then. The cash fortress. Now, I want to push back on the hysteria a little bit here. I mean, companies hold cash. Apple holds cash. Google holds cash. It's dry powder, right? Why are we treating Berkshire's bank account like some kind of doomsday clock?
Because of the magnitude. We have to be very, very careful not to normalize this number. You can't just apply standard corporate treasury logic to what Berkshire is holding right now. The figure we're looking at is $382 billion.
$382 billion. It's a number so big it just becomes abstract. It doesn't even feel real.
Okay, let's make it concrete then. This isn't just a rainy day fund. This hoard of cash is larger than the gross domestic product of Israel.
The entire country's output for a year.
It is larger than the entire economy of Ireland. It's larger than Singapore's. We're not talking about a company's cash pile anymore. We're talking about a nation-state's treasury.
Okay, comparing a company to a country is a great headline, I get that. But practically speaking, what does that mean? Does that cash pile actually give him the maneuverability he needs? Or is it just a drag on returns at this point? People want their money working.
That's exactly the right question to ask. And the answer is in the purchasing power. Think about it in terms of the S&P 500. With $382 billion, Berkshire could buy Disney.
The whole thing. Parks, movies, everything.
The whole thing. Outright. For cash. Then, after buying Disney, they could buy Netflix. Then after that, they could buy Uber. They could buy all three of those massive culture-defining companies outright in cash and still have $100 billion left over for lunch.
Okay, that really puts it in perspective.
Yeah.
He could effectively buy the entire media and transportation landscape of the modern consumer and still have walking around money.
Exactly. And here's the metric that matters most, the one that really answers your question about drag. This cash represents roughly 31% of Berkshire's total assets.
31%.
That is a record high. To give you a historical benchmark, Before the 2008 financial crash, the great financial crisis, where the global banking system very nearly collapsed, Buffett's cash position was around 15%.
Wait. Say that again. So relative to his total book, he is holding more than double the percentage of cash now than he was right before the housing bubble burst.
He is twice as defensive now as he was in 2007. And you have to ask yourself, why? You don't stockpile that much ammunition, that many resources, unless you are preparing for a nuclear winter in asset prices. You just don't. It is fundamentally inefficient capital allocation unless you believe the only alternative is total destruction of that capital.
But let's get into the mechanics of this cash, because it's not, sitting in a checking account at Wells Fargo earning zero. It's in short-term U.S. Treasury bills.
Correct. And this is really where the whole "he's just an old man" argument completely falls apart. This isn't a passive move. This is a sophisticated arbitrage play. At the time he was accumulating this mountain of T-bills, they were yielding about 5.4% risk-free rate.
The hurdle rate, that's the key. Buffett looked at the stock market with companies trading at 25, 30, sometimes 40 times earnings. And then he looked at T-bills paying 5.4% guaranteed by the full faith and credit of the U.S. government.
And he made a choice.
He essentially became a liquidity provider to the U.S. government. This cash pile, just sitting there, generates about $20 billion a year in interest.
$20 billion. That's more than the annual earnings of most companies in the S&P 500.
For taking zero risk, absolutely zero. This is the crucial point that I think a lot of people miss. Buffett didn't just go to cash out of fear. He looked at the S&P 500 earnings yield, which is just the inverse of the PE ratio, and realized it was lower than the yield on a T-bill.
So you could get paid more for doing nothing than for owning a piece of corporate America.
Why would you take on equity risk, volatility risk, management execution risk, and geopolitical risk to earn less than the government will pay you to do absolutely nothing? The math doesn't work. It's the ultimate no. He's looking at the entire American economy, the AI revolution, the reshoring of manufacturing, everything we're excited about, and saying, no thanks, I'll take the coupon.
It is a cold, hard, mathematical rejection of the equity risk premium. He is stating, with $382 billion, that stocks at these prices do not compensate you for the risk of holding them, period.
Which leads us to the how. You don't get to that number by, saving your lunch money. You get there by selling things.
Yeah.
A lot of things. And this is where the autopsy gets a little bit bloody. Segment 2, the dissection.
The liquidation, it really was.
I mean, we're talking about 12, maybe 13 consecutive quarters of being a net seller. For 3 full years, he was just hitting the bid on his own portfolio.
He was a net seller for 3 years straight. Just think about the psychology of that. While the rest of the world was leveraging up, buying call options, chasing the post-COVID boom, Buffett was quietly, methodically exiting the building.
And the most telling sale of all wasn't even to the public, was it? It was a sale to himself, or rather, the lack thereof. He stopped buying back Berkshire stock.
That is the loudest signal in the entire room. Buffett has said time and time again that he will buy back Berkshire stock aggressively when it trades below its intrinsic value. It's the best use of capital. By halting those buybacks, he is effectively telling you, his shareholder, I don't even think my company is a bargain right now.
If the master of value doesn't want to buy the highest quality industrial conglomerate in the world, what does that say about retail investors piling into meme stocks? It's a bit of a chilling disconnect.
It's a chasm, precisely. But let's look at the specific organs he removed. The Apple incision. This is the big one.
This was the one that hurt to watch. I mean, Apple was the crown jewel. It was 50% of the public equity portfolio at one point. He called it the third pillar of Berkshire, alongside insurance and the railroad. And then he just cut it.
He didn't just cut it. He gutted it. He reduced the stake by roughly 70 to 75% from its peak. It went from half the portfolio to about 20%.
Now, the bulls will say, and they do say, this is just prudent portfolio management. It got too big. You have to trim your winners. He had to rebalance.
You don't trim 75% of a position because of portfolio hygiene. That is an exit. That's a fundamental change of heart. We need to look at the valuation. When Buffett first started buying Apple back in 2016, it was trading at roughly 15 times earnings.
Right, I remember that. Everyone thought the iPhone growth was over. It was a dying hardware company.
People were laughing at him. They thought he'd lost his touch. But he saw a global consumer staple, a toll booth on modern life, trading at a deep value multiple. But by the time he sold, it was trading at 33 times earnings.
So the multiple more than double.
The multiple exploded, the earnings grew, which was great, yes, but the price people were willing to pay for every dollar of those earnings went into the stratosphere.
So for him, the margin of safety just, it evaporated.
Completely. At 15 times earnings, you have a cushion. If things go a little wrong, you're probably okay. At 33 times earnings, Apple has to execute perfectly for the next decade just to justify the current price. And Warren Buffett doesn't bet on perfection. He bets on mispricing. The mispricing was gone.
But there was another layer here, right? It wasn't just valuation. There was the tax angle, the so-called one big beautiful bill.
Ah, yes. The OBBA.
I wanted to ask about this. How much of this selling spree was just savvy tax planning? Was he just trying to get ahead of the IRS?
I think it was a huge factor. You can't separate the two. Look at the legislative landscape. Buffett is, above all, a pragmatist. He was sitting on hundreds of billions in unrealized gains in Apple. The corporate tax rate was at 21%, a historic low thanks to the 2017 tax cuts. But with the U.S. fiscal deficit exploding, he knows that tax rate has absolutely nowhere to go but up.
So he decided to lock in the 21% rate while he still could.
He did the math. It's that simple. If the corporate tax rate goes to 28% or even 35% in the future, waiting to sell could cost his shareholders tens of billions of dollars. By selling when he did, he captured the low rate. It's a masterclass in tax-efficient asset allocation. He saved billions for Berkshire just by timing the exit with the tax code.
It's never just one thing with him, is it? It's always this multi-layered thinking. It's valuation and taxes and portfolio concentration.
It's always.
But let's talk about the other major sector he abandoned, the banks. To me, this is almost more worrying than selling Apple.
The Bank of America extraction.
He sold, what, about 50% of the stake? And banks are the ultimate proxy for the U.S. economy. If you bet on banks, you're betting on people paying their mortgages, businesses taking out loans, consumers using their credit cards. It's a bet on America itself.
And this is where we need to look at his book value rule. Buffett loves buying banks when they trade below their tangible book value. It means you're literally buying a dollar of assets for 80 or 90 cents. He bought Bank of America when it was distressed back in 2011.
He was the white knight, swooping in to save them.
He was a shark in knight's armor. He got an incredible deal. He bought it cheap. But recently, it was trading at a significant premium to its book value. So on a simple valuation level, it was time to sell. But I think there's something much deeper going on here than just the book value multiple. I think he's looking at their loan books.
You mean the commercial real estate ticking time bomb?
That's exactly what I mean. Who holds all the paper on all those half-empty office towers in major cities? Who lent money against those shopping malls? It's the regional and the major banks. If Buffett believes we are heading for a credit cycle downturn where defaults start to rise, the banks are ground zero. You want to get out of the building before the fire starts.
So selling BOA wasn't just taking profits. It was effectively shorting the American consumers and American businesses' ability to pay their debts.
It is a profoundly pessimistic signal about the health of the underlying economy. It's one thing to say a tech stock is overvalued. It's another thing entirely to say the banking system is too risky.
That is a chilling thought. And then there's the other tech angle. We talked about Apple, but he also took a hatchet to Amazon.
The Amazon amputation. Slashed the stake by 77% in his final quarter.
Now that one is confusing. Amazon is the AI play. It's AWS. It's the cloud infrastructure the whole revolution is built on. Why would you sell the future?
Because the future is incredibly expensive. Amazon is spending tens and tens of billions of dollars on CapEx building data centers, buying NVIDIA chips, R&D. Buffett looks at that and asks a very simple, old-fashioned question. What is the return on my invested capital?
He thinks they're basically setting money on fire just to chase the AI hype train.
Or at least that the payback period for that investment is too long and too uncertain. When you have risk-free rates at over 5%, a giant speculative project that might pay off in 10 years looks terrible from a mathematical standpoint. Why take that risk when you can get a guaranteed return right now? Selling Amazon is a vote of skepticism against the immediate profitability of the AI build-out.
It's so interesting that he's not alone in this thinking. We saw in the research that the English Warren Buffett, as they call him, made very similar moves.
Terry Smith, yes.
Yeah.
He runs the Fundsmith Equity Fund in the UK, a brilliant, no-nonsense, buy-and-hold quality investor. And at the exact same time Buffett was liquidating these positions, Terry Smith exited MasterCard entirely and significantly cut his stakes in Meta and Microsoft.
So the smartest, most disciplined value investors on both sides of the Atlantic are looking at the same market and coming to the exact same conclusion.
It's a consensus of the elite. They're looking at these mega-cap tech valuations and collectively saying, we are done, the price no longer makes sense.
Okay, so we know what he did. He sold the winners, he sold the banks, he hoarded an unprecedented amount of cash, but now we need to diagnose why. Why does he think the patient is terminal? Because if I look at my screen, the S&P 500 looks manic, not terminal.
Manic is the perfect word, and Buffett has a very specific thermometer he uses to measure that market mania. It's his favorite macro indicator, the Buffett Indicator.
Total market cap to GDP. It's the simplest, most elegant ratio in all of finance, really.
And usually the most accurate over the long run. It simply measures the total value of all U.S. stocks against the actual economic output of the country, the GDP. Historically, the average is about 100%. If the market is worth 100% of GDP, it's generally considered fairly valued.
And where are we now? Or where were we when he made these moves?
In the run-up to this historic transition, the indicator hit 223%.
223. So the stock market is priced as if the economy is more than double its actual size?
We are 77% above the long-term trend line. Now, to give you some context, during the absolute peak of the dot-com bubble, which everyone now agrees was certifiable insanity, the indicator was roughly 150%.
So we are far, far beyond the dot-com bubble peak.
We have blown past it, and I know what you're going to say. The bulls will argue that today's companies are different.
Exactly. They'll say tech companies have higher margins. They're global. They're not like those old dot-com companies with no earnings. Maybe the old rules don't apply anymore.
This time is different are the four most expensive words in the English language. And Buffett has heard them in every bubble. Yes, margins are higher. But are they 77% higher? Sustainably? Forever? Capitalism is designed to compete away excess profits. They always revert to the mean. Buffett knows this better than anyone. He has explicitly called anything over 200% playing with fire. At 223%, we aren't just playing with fire. We are doused in gasoline and juggling torches.
So gravity has to kick in at some point. The ratio has to come down.
Gravity has to kick in, but here's the part that I think people miss. It doesn't have to be a dramatic 1929-style crash. It could just be stagnation, a lost decade.
The JP Morgan data you mentioned.
Exactly. JP Morgan did a massive historical analysis of forward PE ratios going back decades. They found a very clear, very painful rule. Whenever the S&P 500's forward PE ratio crosses 23x, meaning you are paying $23 for every $1 of next year's expected earnings, the subsequent 10-year annualized return is practically zero, or even negative.
Zero. For a full decade.
Imagine buying the S&P 500 today and waking up in 2036 with the exact same purchasing power you started with. You've taken on 10 years of risk, 10 years of volatility for absolutely nothing. That is what the math predicts at these valuation levels.
And all of a sudden, that 5.4% yield on a boring old T-bill doesn't just look good. It looks like a winning lottery ticket.
It looks like absolute genius. If stocks are priced to give you 0% and T-bills are giving you over 5%, the bondholder wins by a landslide. It's not fear, it's just arithmetic. Buffett is choosing the path of mathematical certainty over speculative hope.
Okay, I want to pivot here because this is fascinating. Let's go to segment 4, the anomalies. Because if we just stop here and say he sold everything, we're missing the nuance. He actually did buy some things. And they are. Well, they're weird.
They are delightfully weird. This is where you really see the classic Buffett personality shine through. He didn't just retreat into a cave and hoard gold. He just rotated from what he saw as growth at an insane price to survival at a reasonable price.
Let's start with the pizza. Domino's Pizza, ticker DPZ. He bought this for 6 consecutive quarters leading up to his retirement. Why Domino's?
I love this trade. It's a classic recession hedge. Think about consumer behavior in a downturn. When the economy gets tough and people lose their jobs, they don't stop eating, but they stop going to the fancy steakhouse. They stop going to the casual dining spot that costs $100 for a family of 4.
They trade down massively.
They trade down to the highest calorie per dollar ratio they can find, and that is Domino's Pizza. It's cheap, it's convenient, it's delivered to your door, and it feeds a whole family for $20. It is a recession-proof business model.
But isn't the fast food industry struggling with labor costs and inflation?
Some parts are, but look at the Domino's business model specifically. It's largely a franchise model. They take a royalty right off the top-line revenue from their franchisees. They don't have to pay for the cheese or the delivery drivers in the same direct way the local store owner does. It's an asset-light, high-margin cash flow machine. And it was trading at roughly 19 times earnings.
So he sold Apple at 33 times earnings to buy pizza at 19 times earnings.
He swapped a luxury good for a necessity. It's the most logical trade in the world if you think a storm is coming.
And then there's Pool Corp. This is the one that really confuses me. Pools seem like the ultimate luxury. If the economy crashes, the last thing anyone is doing is building a new pool.
That's true, but Pool Corp isn't primarily a new pool builder. They are a distributor of supplies, of maintenance products.
Ah, so it's a bet on the installed base, not new construction.
Exactly. Think about the pandemic. Everyone who could moved to the suburbs and built a pool. That created a massive installed base of pools that now exist. And you can't just ignore a pool. It turns into a green, mosquito-infested swamp. You have to buy chemicals, you have to buy new filters, you have to replace the pumps when they break.
It becomes a recurring tax on the homeowner who owns the pool.
It's a non-discretionary expense on a discretionary asset. He's betting on the lock-in effect. People aren't moving because their mortgage rates are so low, so they are staying and investing and maintaining their current homes. It's a brilliant, boring, beautiful bet on recurring revenue.
And speaking of brilliant and maybe a little boring, the New York Times.
A $352 million stake. Small for Berkshire, but very telling.
Newspapers are supposed to be a dead industry. Why is he buying into what everyone else thinks is a dying business model?
Because the New York Times isn't really a newspaper anymore. It's a digital bundle. It's the news, yes, but it's also games, it's cooking, it's The Athletic for sports. But more importantly, think about the AI world we were just discussing.
Sludge. The flood of fake content.
The internet is being absolutely flooded with AI-generated garbage. Fake news, AI hallucinations, bot-driven social media content. In a world where information costs zero and truth is increasingly scarce, what suddenly becomes incredibly valuable?
Trust. A verified source.
A brand name. A moat. The brand, the New York Times, implies that a human being, a professional journalist, verified this information. He is betting that as the world drowns in synthetic content, people will pay a significant premium for reality. It's not a newspaper play. It's an intellectual property play.
That is a fascinating take. He's buying the antidote to the AI chaos he seems to be avoiding everywhere else. But he did buy one tiny piece of the AI infrastructure. Alphabet. Google.
A small stake, about $5 or $6 billion. But yes, very telling in its inclusion.
So why Google? Why not NVIDIA, the shovel seller? Why not Microsoft, the enterprise king?
Two reasons, I think. Valuation and utility. For a while there, Google was trading at a much lower multiple than the other AI darlings. But also, he views products like Google Search and YouTube as digital utilities. They are the plumbing of the internet. Unlike Apple, where you have to make a conscious decision to buy a new $1,000 phone every few years, you use Google 20 times a day without even thinking about it.
He bought the pipes, not the magic elixir.
Exactly. If you look at the common thread, he bought cash flow, he bought franchises, and he bought utilities. He systematically avoided dreams and hype.
Which brings us to our final segment, segment 5. The new sheriff, the man who has to manage this strange new collection of pizza, pools, and T-bills, Greg Abel.
The Greg Abel era begins, and we have to be very clear about who this guy is. He is not Warren Buffett. He is not a stock picker.
He's an operator, right? He came up through the Berkshire Hathaway energy side of the business.
He's an engineer by training, an energy tycoon by trade. He is a keep the lights on kind of guy. Buffett was a capital allocator who bought companies. Abel is a world-class manager who runs companies. The personality and skill set shift is absolutely massive.
There's been a lot of talk about the succession discount. The stock took a bit of a hit when the transition finally happened. The market seems to think the magic is gone.
Of course. That's predictable. Buffett is the brand. But I think the market is looking at this completely the wrong way. I think Warren Buffett gave Greg Abel the single greatest gift a predecessor has ever given a successor in corporate history.
A clean slate.
A clean slate and a loaded gun. Imagine this is your first day on the job as the world's most famous capital allocator. You sit down at your desk, and your starting position is $382 billion in cash and zero bad assets on the books.
He doesn't have to spend years cleaning up or apologizing for Buffett's old mistakes, because Buffett sold them all.
He sold them all. And here's the scenario that should keep you up at night, in a good way, if you're a Berkshire shareholder. If the market crashes, if that Buffett indicator is right, and we see a 30, 40, maybe 50% correction, Greg Abel instantly becomes the most powerful man on Wall Street.
Because he's the only one with liquidity. The only one with cash.
While everyone else is getting margin calls, while private equity funds are blowing up, while hedge funds are being forced to liquidate their best assets to meet redemptions, Greg Abel can step in with his war chest and buy incredible world-class businesses for pennies on the dollar, just like Buffett himself did in 2008 with Goldman Sachs and General Electric.
So Buffett didn't just retire. He set a trap for the market.
He set the stage. He cleared the decks so that his successor, Greg Abel, could be the hero of the next crisis, not the janitor of the last one.
But there's a huge risk here, isn't there? What if the market doesn't crash? What if the soft landing actually happens and stocks just keep grinding higher for years?
Then Greg Abel has a very different but very real problem, and that's the interest rate cliff.
Right. We know interest rates are widely expected to soften. If that 5.4% yield on T-bills drops to, say, 3% or 2.5%.
Then that $20 billion in easy risk-free income gets cut in half, or worse. And shareholders are going to start screaming, "Why are you holding all this cash that's earning less than inflation? Deploy it."
And that leads directly to the rumor we saw mentioned in The Motley Fool and other places, the dividend debate.
The third rail of Berkshire Hathaway. Buffett famously hated dividends. His logic was always, why would I give you $1 when I can reinvest it and turn it into $2? I can spend the money better than you can.
But Greg Abel isn't Warren Buffett. And if he can't find an elephant-sized acquisition to buy, and he can't earn a decent return on his cash,
He has to give it back to the shareholders. He might be forced to initiate a regular dividend. It would be a historic tectonic shift for the company. It would be a public admission that Berkshire Hathaway has finally become a mature cash cow rather than the compounding growth machine it was for 50 years.
a dividend from Berkshire. That really would be the signal that the 20th century is officially over.
It would be the final transition from the Buffett growth era to the Abel utility era.
So let's wrap this up. We've dissected the body. We've looked at the cash, the sales, the weird pizza bets, and the new boss. What is the final verdict from this autopsy?
The verdict is that the patient, the market, is delusional. It's running a dangerously high fever. The thermometer, the Buffett Indicator, is broken at 223%. And the world's best doctor saw it coming a mile away.
Buffett isn't betting on the end of the world. He's just betting on the return of math, the return of gravity.
That's a great way to put it. He's betting on mean reversion. It's the most powerful force in finance. He sold his tools, he hoarded the bandages, and he quietly walked out of the operating room before the patient codes.
And this brings us right back to the follow the money argument. If you were sitting at home right now, fully invested, you're buying the dip on every tech stock, you're chasing the AI rally, and the greatest investor of all time is doing the exact opposite. Who is wrong?
That's the brutally uncomfortable question every investor has to ask themselves. Warren Buffett has survived and profited from 1973, 1987, 2000, 2008. He has almost never been wrong on the big cycle turns. He might be early, he is often early, but he is very, very rarely wrong.
So here is our provocative closing thought for you to take away. Warren Buffett played this game for 80 years. He won the game. He became arguably the richest, most respected investor in human history. And in his final move, his grand finale, he took his chips off the table. He cashed out.
If the man who literally wrote the rule book for modern investing decides the game is no longer worth playing, why are you still sitting at the table?
That's the question we'll leave you with. Thanks for joining us on this deep dive. Hopefully your portfolio survives the surgery.
Stay safe out there. It's a tricky market.